Okay, picture this. You're watching the charts, Bitcoin's cruising along at $87,000. And then, in a flash, you see a price of just 24 grand. You'd think the world was ending, right? Well, that's exactly what some traders saw on Binance. But did Bitcoin actually crash? Let's get into what was really going on here.
So that's the big question, isn't it? Did the biggest crypto on the planet really just vaporize over 60% of its value in a single second? Well, let's take a look at the chart that got everyone talking. And there it is. Whoa, look at that thing. It's a single massive red candle with a wick that just plunges all the way down to $24,000. But you see how it snaps right back up? This wasn't some slow, painful slide. This was a violent blink and you miss it kind of move.
So let's start right there, with the hook, that absolutely shocking price wick. I mean, at first glance, it looks terrifying. But as you're about to see, the real story here is way more interesting than just a simple crash.
Here we go. This is our first huge clue. This whole crazy move, it didn't show up on any of the other major Bitcoin pairs. It was completely isolated. It didn't happen on the big BTC/USD chart or the BTC/USDT chart that most people trade. And that brings us to the context, which is everything in the story. This was a totally isolated incident.
Check this out. On the left, you've got the one and only culprit, the BTC/USD1 pair on Binance. But then look on the right, the major, high-volume pairs, they barely even flinched. So the problem wasn't Bitcoin itself. The problem was this very specific pair involving a stablecoin called USD1.
So the key players in this little drama are the exchange, Binance, the specific trading pair, BTC versus USD1, and the stablecoin itself, USD1. Now, the most important detail here, the thing that unlocks this whole mystery, is that USD1 is a newer, less traded stablecoin. Remember, and that gets us to the really fun part, the explanation. Let's break down the anatomy of what the pros call a flash move, because this wasn't really a change in Bitcoin's value. It was more like a technical glitch in the market's plumbing. The main villain in our story is this concept called thin liquidity. Now, in plain English, all this means is that there just weren't many people ready to buy or sell Bitcoin on that specific USD1 pair at that exact moment. The list of active orders, what we call the order book, was super shallow. So here's how it all goes down, step by step. First, you've got that shallow order book. Then, bam, a huge sell order hits the market. Maybe it's a big trader, a forced liquidation, or some automated bot going wild. This one order is so massive, it just instantly eats through all the buy orders sitting near the current price. With no buyers left to stop the fall, the price just free falls until it finally hits the next buy order, which was way, way down the book at $24,000. Then, almost instantly, arbitrage bots see this insane discount, they swarm in to buy, and the price snaps right back to normal. And you know what made it even worse? The timing. This all happened late on Christmas Eve, during really quiet trading hours. With fewer people at their desks, there was even less liquidity to soak up that huge sell order, which just made the whole effect way more dramatic. Okay, so that's the how. But now for the most important part, the takeaway. What does this technical weirdness actually mean for you as a trader or an investor?
First off, you gotta understand this was a market microstructure event. It tells you absolutely nothing about the real value or direction of Bitcoin. Second, this is a huge flashing warning sign about the risks of trading on these new thinly traded pairs. So, next time you see a crazy price wick like this, your first reaction shouldn't be to panic sell. It should be to investigate. And always, always check the liquidity on some new obscure pair before you even think about trading. So, to wrap this all up, what's the real story behind that terrifying $24,000 Bitcoin price we saw?
So, did Bitcoin crash? No. Absolutely not. What we all saw was a momentary, technical breakdown on one single isolated low-liquidity trading pair. It was basically a ghost in the machine, not a true reflection of Bitcoin's real value in the market. So the bottom line is, it was a really fascinating glitch, but it was not a market crash. If you want more explainers just like this one that help you cut through the noise and find the real signal in the crypto world, you know what to do. Make sure to like, share, and subscribe to Crypto Explorer 24/7. Thanks for tuning in. So just when you thought everyone was settling in for a nice, quiet post-Christmas break, the markets decided to throw a massive curveball. While old-school assets like gold were literally hitting record highs, Bitcoin, well, it took a pretty serious tumble. So what in the world happened?
Let's get into it.
You know, this quote from a Reddit user just perfectly sets the tone. It's a blunt, honest reminder that after a year like 2025, a year that humbled pretty much every expert out there, anyone claiming they know what's next for crypto, they're probably just trying to sell you something.
And yeah, that brings us right to this holiday market mystery, where we saw two completely opposite stories playing out as the year wrapped up. I mean, look at this. On one side, you had crypto assets, Bitcoin, Ethereum, you name it, just sliding. But on the other hand, you had precious metals, the old guard of safe havens, and they were absolutely soaring. It was a total split, and it left a lot of folks just scratching their heads.
And the timing here is so important. This all went down right after Christmas, a time when there was a lot of geopolitical tension and not a lot of trading happening. This is exactly the kind of environment where an asset that's supposed to be a store of value should shine. But it didn't.
So that's the big question, right? Why did all this money suddenly run for the safety of old school metal instead of what's been called digital gold? Well, the first clue is all about who was doing the selling. And that leads us straight to our first major clue, a huge sell-off that was driven by some really, really big players in the crypto market. Okay, so this wasn't just some random flash crash on Christmas Day. The stage for this was actually set months before. After hitting that incredible all-time high of over 126 grand in October, Bitcoin started this really painful correction that just came to a head over the holidays. 32%. Think about that. That's a drop of nearly $40,000 from its peak in just a couple of months. So, the billion-dollar question is, who was selling? Well, on-chain data seems to point to a very specific group, the new whales. These are big money investors who jumped in near that all-time high, probably chasing the massive hype. But here's the thing. They hadn't been through a real, brutal crypto winter before. So when things got rocky, they got cold feet and panic sold. And this is where psychology really comes into play. You had the new whales panicking, creating this huge downward pressure. But at the same time, the long-term holders, the folks who've seen this all before, they barely even flinched. And honestly, their stability probably stopped things from getting even worse. So with this massive sell-off from all the newer investors, Bitcoin's biggest story, the whole idea that it's digital gold, was suddenly put under some really intense pressure. I mean, the numbers for 2025 tell a really stark story. While actual gold was up a staggering 70% for the year, Bitcoin actually finished the year down 6%. For an asset that's supposed to be a hedge against uncertainty, that's a huge miss. And think about the world we were in. Geopolitical tensions were on the rise. People were worried about governments devaluing their currencies. These are, theoretically, the perfect conditions for Bitcoin to prove its worth. But instead, the big money ran to the asset that's been a reliable store of value for thousands of years. Real, physical gold. And the data completely backs this up. This chart here shows the correlation between Bitcoin and gold. And as you can see, the relationship is just weak and totally unpredictable. It didn't get stronger when the markets got shaky, which is the exact opposite of what you want from a safe haven asset. All right, so you've got institutions running to gold and new whales panicking. But what about the everyday investor? How are they feeling about all this? Well, let's just say they were getting pretty tired of all the broken promises. Remember, all year long, you couldn't escape these wild predictions of Bitcoin hitting $200,000, maybe even $250,000. So when the market went the other way, the community's patience with these so-called experts just ran out. The whole mood, especially on forums like Reddit, it just turned really cynical. I mean, you can just feel the frustration in comments like this one. The whole vibe shifted from that to-the-moon optimism to this really deep-seated distrust of anyone who claimed they could predict the future. And this quote, wow, this one perfectly captures how this whole counterculture was born. Instead of listening to the big names, a lot of people started doing the opposite. They started to inverse them, basically betting against whatever the experts were saying. So all this chaos, all this drama, it really makes you ask a bigger, more fundamental question about what Bitcoin is actually becoming now that it's gone so mainstream. Look, the launch of the spot Bitcoin ETFs in early 2024 was supposed to be the big moment, right? It was meant to bring in all this stable institutional money and make the asset class legitimate. But it looks like it might have had an unexpected side effect.
And this chart right here, this shows you exactly what happened. This is Bitcoin's correlation with the S&P 500 stock index. Just look at that sharp, steady climb right after the ETFs were approved in January. Bitcoin started moving more and more like just another stock.
So, this is the big question we're left with. Has all this institutional money actually changed Bitcoin's DNA? Is it losing its identity as a safe haven asset, a place to go when things get scary? And is it just becoming another high-risk tech stock that gets dumped whenever the market gets nervous? That right there is the billion-dollar question for its future.
Hey, if this breakdown helped you make a little more sense of all the market chaos, do me a favor and hit that like button, share this explainer with a friend, and definitely subscribe to Crypto Explorer 24/7 for more deep dives just like this one. Thanks for hanging out with us. Welcome to the explainer. Today, we are diving into a massive shakeup in the Bitcoin mining world. It's creating some absolutely huge winners and, well, some pretty surprising losers. All right, let's get right into it. What we're seeing in 2025 is this huge divide in the Bitcoin mining industry. It's almost like it's split into two completely different camps, and boy, has the stock market picked a favorite. You've got the winners, the ones who diversified into AI, and then you have the laggards, the ones who are still pure clay Bitcoin miners, and the gap between them, it's just staggering. Just take a look at this. On one side, you've got companies like Iron. Their stock has just skyrocketed. We're talking an incredible 300% gain this year alone. And it's all because they made that pivot into AI. But then, on the complete opposite end of the spectrum, you have BitDare. I mean, this is one of the biggest names in the game, and their stock has been cut in half. So what on earth is going on here? How can two companies in the exact same industry have such wildly different fates? It doesn't seem to make sense, right? So here's what we're going to do. We're going to break it all down. We'll look at the strategy that's clearly paying off, why just mining Bitcoin isn't cutting it anymore, dig into a really interesting paradox at the heart of all this, and then figure out what the new playbook for success actually looks like. All right, first up, the AI pivot. Honestly, the whole story of 2025 really boils down to one single, massive strategic move, and that is pivoting to artificial intelligence. So the miners who got this right, they repurposed their energy and all that infrastructure they'd built and turned it towards AI data centers. And they landed massive deals with tech giants, completely flipping their financial futures. Iron got backing from Microsoft, Cypher expanded its partnership with Fluidstock, and Hut 8, get this, they locked in a $7 billion 15-year lease. These weren't just little side hustles, this became their main engine for growth. And the numbers, wow, the numbers really tell the story here. Take a look at Iron's May update. Sure, Bitcoin mining still brought in more total revenue, but look at the profit margin on their AI cloud services. A mind-blowing 98%, that's a huge signal. It means that pretty much every single dollar they're making from AI is pure profit. It just goes to show how insanely lucrative this pivot has been for them. And all this success with AI really shines a spotlight on a critical point for this market. In 2025, if your only strategy was to just mine and hold Bitcoin, well, it turned out to be a losing strategy. I mean, just look at Marathon. They're the biggest Bitcoin holder of the bunch, and they're down 44%. And think about it, Bitcoin itself was only down about 7%. The market really punished these companies for what it saw as weak earnings and, frankly, a lack of strategy beyond just stacking sats. All that crypto they had in their treasury, it just couldn't save their stock prices. Okay, but this is where the story gets really, really interesting. This brings us to what I'm calling the BitDare paradox. So yeah, Wall Street has absolutely punished BitDare's stock. But the big question is that the whole story? Is that what's actually happening on the ground? Well, the answer is it's a whole lot more complicated than that. Because if you stop looking at the stock price for a second and look at their actual operational power, BitDare is a global leader. I mean, they're running at 35 exahash per second. That's more than double the hash rate of Iron, the market's darling right now. So let's be clear, this isn't some small company struggling to keep up. This is an industrial giant. And when you look under the hood, their fundamentals are just rock solid. This company is growing at a staggering pace. They've locked in some of the cheapest energy costs in the entire industry. And this part is absolutely key. They're building their own hardware. They are controlling their destiny from the ground up. Yeah, that's their secret weapon, their in-house hardware. See, they aren't just buying rigs off the shelf like everyone else. They're actually innovating.
Tech reviewers are looking at their seal miner rigs and saying things like, the fit and finish is great, that it feels like it was made by someone who's been mining forever. They are solving the little problems that only veteran miners would even think of.
So where does that leave us? What does all this mean for the future of mining? Well, it seems like the new playbook isn't as simple as just picking a side, AI versus Bitcoin. It's way more about your overall strategy and how well you can execute on it.
You see, the market is changing. It's moving away from rewarding pure crypto miners. Instead, it's starting to value these versatile, large-scale data infrastructure providers. The winning companies are turning themselves from just miners into something much, much bigger. They're becoming masters of energy and infrastructure, able to serve both crypto and AI. And this is really where it all comes together. Check this out. Financial analysts at B. Riley Securities are looking at this exact same situation. And they rate both IRON, the AI winner, and BitDeer, the operational powerhouse, as a buy. So, wait a minute. How can they both be winners? It really shows that there's more than one path to victory here. The market is rewarding IRON's quick, successful pivot to AI right now. You can see it in their stock price. But at the exact same time, those same analysts see this deep, long-term value in what BitDeer is building. You know, its massive scale, its efficiency, its vertical integration. They see so much potential that they're actually giving BitDeer an even higher price target. So, what's the big takeaway here? Maybe the real battle for the future of Bitcoin mining isn't about jumping on the latest trend, whether that's AI or something else. Maybe it's about becoming a master of energy and infrastructure. It's about building a business that's so resilient and powerful that it can thrive no matter what the next big thing is. Hey, if you enjoyed this explainer and got something out of it, do me a favor and hit that like button. Share it with someone you think needs to see this, and of course, make sure you subscribe to Crypto Explorer 24/7 for more deep dives just like this one. Thanks so much for watching.